Morning everyone, I'm Dr. Tishtabachu, and today we are going to talk about private equity versus private debt. This is going to be helpful for fund administrators and accountants, mainly in Luxembourg or any other EU countries, which follow obviously a similar fund strategy. So basically, if you work in fund administration and fund accounting in Luxembourg, you've probably worked on both private equity and private debt funds. You might have booked capital calls, interest accruals, NAV movements, fair value changes, etc. But the real question is, do you truly understand how different private equity and private debt are economically and from an accounting perspective? Maybe not. And in this video, I'll explain the difference between private equity and private debt, specifically in the context of Luxembourg funds, in a way that makes your day-to-day work easier. Okay, so now the first one is private equity. What is private equity? We'll start with this one. Private equity means owning a company. Okay, here you actually own the company. When a private equity fund invests, it is buying shares or ownership interest in unlisted companies, usually with the intention of improving the business and selling it later at a higher value. So under private equity, what happens is, for example, we do have in the whole world, we do have many companies unlisted, not doing quite well, underperforming, loss making, and so on. So what happens is private equity fund, we look after those companies. We look around and see whether we can invest, we can buy those companies. So we do find them and we buy those unlisted companies. We make them better. We improve the business. Okay, we make them profitable with the idea of selling them later at a higher value and making a profit out of it. Okay, in Luxembourg, private equity funds are commonly structured as SCSp, which is well known as for partnership. So SCSp, we have some in the form of SOLs, we have some in the form of RAIFs and the SIFs. Okay, from a cash flow perspective now, private equity is very irregular. That is, investors commit capital, the fund makes capital calls whenever they need capital, right? It can be from a monthly basis, quarterly basis, 3-month period or 6-month period, but whenever the fund needs capital, we request investors to make the capital call, or like to put in the capital which they have initially committed for. And distributions usually happen only when an investment is exited. That is, when the investment is eventually sold after being profitable, then the investors will be entitled to get the distributions. Okay, from an accounting perspective now, this is very critical. Private equity funds do not generate regular income like you would see in a real estate fund or infrastructure fund. For example, a real estate fund, let's say we have a few hotels. The hotel now, they are a drive for daily activities. So there are people coming, staying in the hotel. There are some activities which is helping the hotel or the real estate to generate regular income. Unlike those, private equity funds do not generate regular income. There is no interest. Okay, there is no predictable cash inflows. Okay, most of the net asset value movement, the NAV movement in private equity funds, are coming from fair value changes of underlying investment. Okay, when the value is going up because it's doing well, etc., then obviously there will be a fair value change in that investment, and this is the movement which impacts the NAV. It can be a higher amount, it can be a lower amount, but that's the only movement which really impact the NAV, because there's no other cash inflows or monthly interest being accrued. So if you're a fund accountant, your main focus in private equity is valuation, not really income. So you need to focus on what is happening to your investment, what is happening, the value of those investments. Are they increasing on a monthly basis? Are they decreasing on a quarterly basis? This is going to be your main focus. Okay, because this is going to change the NAV. Okay, now moving on, this time we are talking about private debt. Okay, private debt is quite different. Here the fund is not buying the company. You'd remember, private equity means we own the company, Here under private debt, we do not buy the company. The fund is not buying the company. Instead, the fund is lending money to a company. Private debt, it is about lending money to a company. Okay, if I can give you a simple example, let's say we are working in Luxembourg, you will be acquainted to this form of fund, SCSp, which is also known as the partnership. Okay, so we have the main fund here, then we have the holdco. Okay, then the holdco has several SPVs in different countries. SPV maybe in Italy, in Madrid, in the UK, in Portugal, Albania, wherever. Okay, so we have SPVs in different countries. Those SPVs will be holding the asset. Let's say these are the asset. Can be school, can be hospital, can be hotels, anything. So now, to be able to acquire these assets, okay, to be able to build these assets, we need money. From where will we get the money? Obviously, from the SPV. The SPV needs to buy those assets through a share a purchase agreement or share purchase agreement, SPA, or any sort of agreement, right? So it's the SPV, it's the role of the SPV to buy the house. But from where does the SPV get the cash? The cash needs to come from the fund. Okay, the cash comes from the fund. Of course, it does not come straight like this arrow. It will come via the holdco. So for tax purposes, what does the SCSp does? The SCSp sends the money to the holdco through a loan. Okay, through a loan, and then the holdco send the same amount or the required amount to the SPV, the same loan. Now, of course, we need to have loan agreements between the SCSP and the holdco, and another agreement between the holdco and the SPV. Okay, now very important, to be able to make an income out of this transaction, it is important for the SCSP to have a transfer pricing analysis done to ensure that the loan that they are giving to the SPV for the purchase of the asset, it is measured at arm's length rate, and we do have a margin whereby we get an interest income. It can be 10%, it can be 12%, it can be 15%, it can be lower than 10%, but it has to be something done through a transfer pricing analysis. And usually in Luxembourg, we will have more comfort is if the TP analysis is run through by a big four company. We have more comfort when they come and tell us, yes, okay, you are investing or you are buying an asset in Italy, so the transfer pricing has been done for an asset in Italy, therefore the margin has to be this and this percentage. Okay, of course we can discuss, we can negotiate about the percentage, but there is always going to be a specific range for specific jurisdiction. Now, why do we do that? Why do we not just give a loan? Because at the end of the day, it's the same company just buying, investing in an asset. Why do we have to actually put a margin there to gain interest? Is because in this private debt fund, one of the way to get money is through interest income. So basically the SCSP is giving a loan, but then once we sell those assets, or yes, let's say we sell those assets, we are going to pay back the loan to the SCSP with an interest. The interest will be also distributed eventually to the shareholders, to the investors, to the LPs. In Luxembourg, we also call them limited partners, or we call them investors. They are the one who put in money in the fund to invest in those little houses here. So when the houses are generating income or it is being sold, the LPs need to get the cash from them. Okay, that's the whole purpose of raising capital from investors, because when we are going to generate cash income, they need to be entitled for those profits as well. Okay, so private debt, again, we are not buying the company. Instead, the fund is lending money to companies, to those SPVs. The return comes mainly from interest, but not from selling the company. We are not going to sell the SPVs to generate income. Yes, at some point we are going to sell the assets, but not the SPVs. Okay. Now, private debt instruments include senior loans, mezzanine debt, mezzanine loan or mezzanine debt, unitranche loans, and sometimes convertible instrument. But convertible instrument is not very, it's not something too fancy, too famous in Luxembourg. We do have some, but not as much. Main instruments that you would come across in Luxembourg is senior loans, mezzanine debts, and unitranche loans. Okay, now in Luxembourg also, private debt funds are also structured as RAIFs, SIFs, and SCSPs, also known as partnership. Okay. Now, from an accounting perspective, private debt looks much more familiar to accountants. You would usually have regular interest accrual.
We would also have the payment in kind interest, any arrangement fee that appears on the LPA or the issuing document.
We are going to look at the key differences side by side. So let's have a comparison on whatever I have just explained and talk about between private equity and private debt. So let's put it side by side because this is where many people get confused. In private equity, the fund owns companies. Okay, ownership is important here. In private debt, the fund is a lender. We are lending money. Okay, we are lending money. In a private equity, returns come mainly from exits. That is, when we are selling the asset, we are going to generate income and then we distribute the income. In private debt, returns mainly come from interest. In private equity, cash flow are irregular. So we don't really know about the cash flow, what is expected and what not. But in private debt, cash flows are relatively regular. Okay, because we know we are going to get the interest, we know the PIK payments, we know if there is any arrangement fees, all that. How do we know them? Because we do have legal documents. For example, if it is an SCSp, we will have an LPA which tells us about arrangement fees and so on. We will have an issuing document in the case of a SIF which tells us about all these fees. We would also have a share purchase agreement. We will have a loan agreement which tells us about the rate that we need to calculate the loan interest with. So all these are given and written in these legal documents, which are very important. And I usually call them the Bible of funds. So we cannot do anything without those documents. Okay. So PE fund, the cash flows are irregular, but private debt fund cash flows are relatively regular. From a NAV perspective, private equity NAVs can be very volatile because they depend on fair value estimates. Okay, but private debt NAVs are generally more stable because they rely on interest accrual and amortized cost, although fair value adjustment can still apply. This is what I told you earlier. We also have fair value adjustment in NAVs of private debt, but what we rely more on is the interest accruals and the amortized cost, whether there has been an impairment, etc. So this is very important. A simple way to remember this is, usually I tell my colleagues, my staff members to remember it in this way. Private equity is valuation driven, private debt is accrual driven. Just PE is valuation, PD is accrual. Okay, valuation, accrual. Now, let's have a look at all of these from a Luxembourg perspective. Now, in Luxembourg, this distinction is especially important. From a regulatory and reporting perspective, both private equity and private debt funds usually fall under the most AIFM, the most famous AIFMD rules. So whether we are talking of private equity or private debt, both funds would fall under the AIFMD. And now under the AIFMD, we have millions of rules which we need to follow. Okay, millions of rules which we need to follow. Both the expectations are different. as we have already seen, because they are two different things. We are talking of PD and PE. Both have different aspects, different accounting treatment, etc. And that obviously the expectations are different. Auditors will focus heavily on valuation models for private equity fund. Okay, if you are dealing with a private equity fund, you will be nagged very badly by your auditors at the end of the year, or during audit period, because they will want to have a clear and concise idea of your valuation models, how you are valuing those private equity portfolios, etc. Okay, now simple example is in my company where I work for. We have a private equity fund which is based in Dublin, in Ireland, and obviously the auditors are based there as well. And it's not really an easy audit, because what was happening is, in my company we had we call them valuation experts, because they are really experts. They are really well placed to do their job, but because they are internal to our organization, we were told by the auditors that they will not continue the audit until and unless we go for an external valuer. We need to have an independent external to the company I work for. So they need to be a separate entity who value those models for us. Otherwise, they were that serious that they said they are going to discontinue the audit. So yes, so it makes sense, because they need to have a heavy focus on the valuation models for these funds. What they care about is what are the discount rate that we are using, what are the exit assumptions, etc. So all these need to come from an outside party, apparently. Now, for private debt fund, auditors will focus more on interest recognition, the payment in kind calculations, if any impairment, and credit risk. Okay. Now, as a fund accountant or administrator, understanding the economic substance behind the fund helps you explain the NAV movements to clients, auditors, and investors with confidence. So if you're working as an accountant or an administrator in any of the service, administrator or service provider, as I call them, you need to understand the economic substance behind the fund, because each fund, each fund has a legal substance, because they are all different. We can have a fund in the form of RAIF, in the form of SCSp, in the form of SIF. They have a different economic substance, and we need to understand that to be able to explain the NAV movements to clients, auditors, and investors with confidence. Okay. Now, moving on, the common practical confusions that I usually find is, we are going to go through them very quickly. Usually the question that I get asked a lot is, why is there no income in a private equity fund? Again, if we go back to the first slide, we did come across that one slide which says that private equity fund do not generate any income. Okay, there's no income like interest income or anything in a private equity fund. But why is it so? It's because the return is realized mainly at exit. So we do have an income, but the income is realized only when we sell the portfolio company, when we sell the asset, not through ongoing income. We do not have, ongoing income from interest on a monthly basis. We only get that big return when we are selling the asset. Okay. Second question that we get is, why does the NAV why does the NAV change even when there is no cash movement? Okay, why there is a NAV movement? This is very simple, which I've already mentioned before. The NAV change because the valuations changes. The valuation are updated. Okay, so the value of an asset will increase or decrease, hence the NAV will change. Okay? Because the investment does not remain the same. The value of an investment is changing, not because cash is coming in or out, but rather because the value of the investment is changing or updating. Okay. Another question which is quite recurrent also is, why does a private debt fund still have fair value adjustment? Okay, remember I mentioned that under private equity fund there is also there is there's valuation adjustment, there's fair value adjustment, and I also said it also exists in private debt fund. Although our main concern as accountant is not the fair value adjustment, but rather the PIK payments, the arrangement fees accruals, etc. But doesn't mean that private debt does not have fair value adjustment. They do. Okay, and the question is, why do they still have fair value adjustment? It is because credit risk, market conditions, and expected cash flows can change. So when these changes, all the other factors changes, market condition is changing, of course there will be this is going to trigger a change in the value of the investment. That there will be up and down in the fair value of the investment. Okay, so yes, even in the private debt fund, we do have fair value adjustment. Okay, so I hope this has been an interesting one. I think this is the major issue that many accountants faces. They tend to think of private equity and private debt as interchangeably. They think that they are the same, similar, or the accounting treatment are the same. But no, it's not. They are two. They are two different things. We can put it at the extreme end of each other. But once you understand the differences that both of them have, many of your day-to-day NAV questions become much easier to answer. Okay. Okay, so this is something that we've already looked at. When we talk of private equity, we talk of valuation. When we talk of private debt, we think of accruals. Okay. Now, to summarize, again, just a very quick summary. Private equity is about ownership and value creation over time. Private debt is about lending and generating income. For fund administrators and accountants in Luxembourg, the key difference is this. Private equity is driven by valuation. Private debt is driven by accrual. Okay. Right, so we have come to an end of this session, and I hope it has been helpful one. In case you need any help or anything which is not too clear for you, please shoot me an email. I am on LinkedIn as well. You find me under the same name, so Tishla Bachu. My email address is here. You can comment on my YouTube. If you have not yet subscribed to the channel, please, if you find it useful, subscribe to the channel for more practical explanations on fund accounting, private markets, and financial reporting in Luxembourg. Okay, thank you very much.